Hi everybody, welcome to our July webinars for 2022. For those who don't know me, my name is Jonathan Wu. I'm one of the Executive Directors and the Chief Investment Specialist for Premium Asia Funds Management. Thanks very much for joining us on the line today. Apologies for my casual clothing, as I've recently had a bit of a freak accident and broke my shoulder. So we will carry and move on. So obviously we've got some retail investors on the call today. So just reminding everyone that everything that I express today is of a general nature only, and no personal advice is being given. Please seek the advice of your licensed financial planner if you want to seek further information. First thing, just want to say, so obviously we'll get this done in 30 minutes as usual. Just a reminder, for those of you that are on the call today, obviously you registered for today's session, so you would have also received in the last couple of days our annual investment briefing for 2022. Unfortunately, as most of you may know, Hong Kong is still under a 7-day quarantine style scenario for those returning back to Hong Kong, which means that obviously our fund managers can't serve quarantine as it's not an efficient use of their time. It's obviously untenable for most. So therefore, we will do exactly what we did last year, and we will be running a in-person lunch briefing at the establishment on George Street for anyone in Sydney. And then we'll be beaming in Hong Kong, and for everybody else, we'll be running the online session live stream. So you would have received that in your inboxes earlier this week, 12 to 2 p.m. Australian Eastern Standard Time on Tuesday, the 13th of September. We will send out a couple of reminders from here on out till September. So please, join us. Myself, as well as Renee and Doris, who are the equity fund managers, as well as Gordon, who's the CIO of the fixed income team, will be presenting. So kicking things off this month, just want to share a very simple chart here that basically reflects the last 500 years worth of modern history. And what we see here is that the pattern of rising and falling kingdoms or new world powers over the course of the last 500 years. And what you see here is that there is an inevitable pattern. As we all say in investments, things don't repeat, but they certainly rhyme. And right now, one of the ways to explain why we're seeing so much geopolitical stress in our current lifetimes, where most of us haven't seen it previously, is because China is rising and the United States is in decline. Now, when we say United States is in decline, we're not saying it's, hell in a handbasket in a short term. It is a sort of a long burn, much in the same way that, in the last century, we saw the fall of the United Kingdom as the world's greatest superpower, and then we saw the rise of the United States to be in that space now as the strongest superpower in the world. And what you see is when you have a crossover in that time, which usually lasts 20 or so years, there is a lot of conflict that happens, and right now that is exactly what we're seeing. But in terms of looking forward, one of the things that I want everyone to reflect upon is how are you constructing portfolios to basically look forward in time, and how you're preparing for that changeover in superpowers, because all the geopolitical things that we see today is not something we haven't seen before. So just a quick update on our team in Hong Kong, headquartered in Hong Kong. Value Partners is now managing 8 billion, so we're remaining to be quite boutique. We like this because it means that we're quite nimble in our ability to get in and out of investments, as we're very, very active, as all of you do know. We're still managing 70 members in our investment team, split across Hong Kong, Shanghai, Shenzhen, Kuala Lumpur, Singapore, and London. And that allows us to be very much on the ground, regardless of the jurisdiction. Our key value proposition to you is that we are a relative value manager. So we are looking for contrarian ideas, stocks that are unloved, And ultimately, what we see as our best competitive advantage is that we do at least 6,500 company visits a year. This excludes profit briefings, group calls. These are all, one-on-one meetings or one-on-one video conferences with management that allows us to get those better insights to then find those companies for you. And I'm going to share a couple of those stories with you today of where we're tactically allocating, and again, reflecting back on our relative value style. So the way that we're, constructing our fundamental research team is that we split it by sectors, which is nothing, extraordinary. But what that also means is that about 3 years ago, each of the portfolio managers of the funds actually have to take the best ideas from each of the sector leaders and have at least 50% of their portfolio by fund allocated to those companies. So how does that work? You can see here on this list that there are certain sector leaders. So most of you know that Doris as well as Renee are the actual portfolio managers for the Premium China and Premium Asia Fund. But Renee at the same time is also a sector lead for IT hardware. Doris is also a sector lead for consumption stocks. And so they are sort of filtering the best ideas from the analysts, coming up with the best 5 for each of these sectors. And then the portfolio managers then are deploying that money according to those best of ideas. This creates better consistency across portfolio management. Just a quick word on ESG. So obviously we've received a lot more questions around ESG in the last couple of years. We are a signatory to the UNPRI all the way back in 2019. We effectively, in summary, used a screening, a external third party to do data screening, and unfortunately we found them to be, practically useless because a lot of the data that they were producing was simply out of date and basically held up our ability to deploy money. Because if you can imagine, and I use an example recently, you may know of a company called BYD. BYD is Build Your Dreams. It is the first Chinese electric vehicle company set up about 2 decades ago, but Warren Buffett has a cornerstone investment in them. They recently have been under government investigation because where their factories are positioned, they have seen that there is an increased development of respiratory issues for young people in that region. Now, when we actually looked at every single major screening company in the world, whether it be MSCI or Standard & Poor's, in terms of negative screening for BYD, we found none. The other part of it is we also have to remember where ESG from a reporting perspective originated from, which is pretty much Europe. And ESG and the ability to use ESG effectively as part of your investment process requires companies to actually provide ESG reporting. And in Asia right now, it is next to none. What we do see is that since we basically removed the external screening company, we built our own proprietary scorecard for ESG. And where we see ESG as adding value to our investment process is if there are E and S or G issues, we see those as financial risks. Financial risks then hamper the valuation of the companies, and that's where we see the value add. But if we're looking at it in terms of carbon capture or other factors, it simply doesn't exist because there is just no reporting. So we've been on a journey just like everybody else. And for those of you that may have seen the latest Economist, there is a big article there on ESG, and it is really very much a still work in process across the globe. So let's talk about a couple of metrics. And obviously we've seen Asian equity markets and more specifically Chinese equity markets correct more significantly in the last in the 2021 calendar year, and before that, before we saw most of the Western markets since the beginning of this year also start correcting quite heavily. What we have been able to ascertain now is that there is a very good diversification benefit by being invested in Asia, and more specifically, obviously, our funds, because we're not obviously benchmark agnostic. But what we're trying to do is that we're trying to find ways to, as part of a blended portfolio, offer well diversification and also lower correlation. So what you see here, courtesy of our friends at SQM, this was just airlifted from their latest research report. What they did was they looked at our Premium Asia fund and looked at the worst 10 months for the Australian market, so using the S&P ASX 300 Total Return Index. These are the worst 10 months since the history of the Asia fund, which was December 2009. And what you see here is that in 7 out of those 10 months, we would outperform the Australian market. And sometimes by quite a long shot. So what you can see here is that there is a diversification benefit, and second of all, there's also a correlation benefit. So we ran correlation for both the Premium China Fund as well as the Premium Asia Fund for the 5 years ending 30 June. That's just past the financial year. And what you can see here is that the correlation of, let's say, the Premium China Fund to the S&P ASX 200 is 0.1. Okay, and outside of 2, which is where you can see that's the MSCI Emerging Markets Index, where our correlations is 0.8 and 0.7, you can see that all the other correlations don't even get to 0.5. So again, by blending in Premium Asia and or Premium China, allows you to get very good diversification and also generating a low correlation of returns for your portfolios. If we then look at the current the state of the world, and this is a chart that I've basically updated month on month, is that if we look at the current inflation, obviously we have the major drivers of global concerns at the moment is around inflation. With the latest inflation print, while it is increasing in China, is still at about 2.5%, but then we also have the United States now printing at about 9.1, and even the UK as a comparison point is even higher than that now. Central bank interest rates in China are expected to decrease even from this point. That's also coupled by decreases in the triple R rate, which is the level of reserves that banks hold, so the equivalent of Tier 1 capital ratios in Australia, as well as the prime lending rate, which is the other key rate in China. The government is also reducing to decrease the level of mortgage strain on domestic mortgage holders. And then in the United States, we still expect to see further increases in rates for the foreseeable future. What's very important to realize is that we are now getting to the point where China and the United States have very different thinkings in the ways to stimulate their economies. What you effectively have is, number one, first you have a situation where in China, they want to prevent themselves from printing money like they've seen in the West. So the one thing that we've always maintained is that China can take the best ideas and best policies from Western democracies and implement it in their own society, but in the vice versa, United States can't take the best of China and implement it in their policy because of the authoritarian style of government we see in China. Okay, and there are positives and negatives, but for the most part, it is positive because China can direct stimulus much more effectively at a broad-based level. And what we've seen is that China has spent the better part of the last 2.5 years putting forward a lot of austerity measures to basically slow down the property market and rebalance the economy to ensure that the cost of living pressures, which is mainly around property, mainly around after-school tuition and things like that, those are decreasing, as well as ensuring that they encourage a highly competitive platform industry, which is why you saw in 2021, they had a very strong anti-monopoly campaign in China. If you compare that to the United States, we haven't seen any austerity measures since the Lehman Brothers collapse, and there's no social inclusion policies we're seeing in the United States at the moment versus in China, where they have a common prosperity goal. And what you see here is that common prosperity is all about trying to upgrade the consumer, trying to decarbonize the economy, and also the growing need of wealth management. I'm going to talk about wealth management a little bit later on because there's some very interesting developments, because China last week actually announced the launch of the third and final pillar of their pension system, which is looking a lot more like what we have in Australia's superannuation. But what they want to do is that they want to reduce the level of social unrest that we've seen across the globe, which is reflective of the number of populist governments that have been elected in the last 10 years, and want to ensure that China doesn't go down that same path, and hence, reining in growth, but creating more sustainable growth. We've seen a massive rebalance in the property market, and these are some updated figures to the end of June. Even on a year-on-year basis, you can see the property sales in June of this year compared to June of last year is down more than half still, but on month, you can see some level of recovery. So, but there has been a slight hiccup since then. In July, some of you may have read that there is a new mortgage development, mortgage crisis in China that has started. It started in the city of Henan. Basically, what happens is that what has happened is that a lot of Chinese buyers of off-the-plan property, the way of financing the developer in China is different to Australia. So it is based on progress payments. So when the developer finishes 20%, then you're stumping up the next 20%. Where they finish 40%, then you stump up the next 20%, and so on and so forth. So because there is a fear that some of the developers are collapsing in China, which is true and well documented, what's happened is that some of these mortgage holders that are basically paying their mortgage to fund it are saying, I refuse to pay, because they fear they're not going to receive their completed property at the end of the day. So there has been movement in Henan, as well as a number of other cities where they're looking to set up rescue plans, which will be backed by both by local as well as the central or federal government equivalent, to basically put a hold on or put a bottom line to mortgage distress in China. We've done our own analysis. The biggest risks in China at the moment in the terms of the property sector and this mortgage crisis is really isolated to regional banks, not big banks. We don't have any exposures to small and regional banks. We have exposures to larger banks. And even at the larger bank level, if we look at mortgage stress as a total size of all bank lending in China, we're looking at about 150 basis points. Not overly concerning for us. And we also haven't seen any material uplift in terms of defaulting loans or defaulting mortgages, because the prime lending rate is also dropping. So something to be aware of there. But expect to see continued more developers defaulting, and I'm going to talk a little bit more about that in tomorrow's webinar, same time tomorrow at 12 p.m. Australian Eastern Standard Time, talking about the fixed income fund and the strategy. The Chinese government continues to fine-tune a lot of the property sector by effectively, depending on which city you are in, the federal government has told each individual city to stimulate where they think they're going to get the biggest bang for your buck. So in some places, they've removed the home purchase restriction and 5-year holding periods. In some areas, they've reduced the first home mortgage rate, so on and so forth. If we then look at a valuation perspective, and I think there's a reasonably strong argument to say that most developed economies still have a fair way to go to drop down in terms of market corrections, because none of us, I think, fundamentally see a bottom to the market. That's the honest truth. But when you look at it, China, from a valuation basis, we're now trading at about 6.1 times sort of ending June valuations, where the average since our business started all the way back in 2005 has been 10 times. So we're about 1.2 standard deviations below the average. In terms of this conversation that we're having with investors and advisors in the last couple of months is, okay, when are we expecting to see the Chinese government come out with more material levels of stimulus? Because they seem to be reasonably quiet. The reason why they've been quiet in our understanding and our analysis is that because they are maintaining this COVID zero policy. Now, there's obviously the argument's still out as to whether or not COVID zero is effective or not. Obviously, you're either letting the economy rip, as we've seen in Australia, and even here in New South Wales, we've gotten to about 16,000 cases, and those are the only ones that are reported. But in China, they're basically trying to stamp it out to allow, I guess, the economy to still work around without the same level of absenteeism that we've seen in Western places. Now, that still creates other problems, as we've seen, and speaking to other fund managers, we're also seeing the supply chain issues also compound on the back of this. So when I talk about later about where our portfolios are positioned, if I use the duration analogy, when you have a long duration portfolio that's made up more of high growth stocks, our portfolio has quite drastically changed compared to even 12 to 24 months ago. Our portfolio is far more low duration. We've actually become far more defensive, and I'll talk about that. But in November, we expect that after President Xi is confirmed for his third 5-year term, which will mean that he'll be president for at least 15 years, that we will see more stimulus come out off the back of that. In terms of Taiwan, Taiwan's had a terrible 6 months to the start of the year. Our only holding meaningfully is TSMC. I'm going to talk about that a little bit later on, but Taiwan has sort of been stuck in this perfect storm because there is supply chain bottlenecks, and also there is some evidence there is some drop in demand in semiconductors, but we think that that's not going to be that meaningful at the moment because there is still a clear shortage, that the backlog shortage. So in the same way, the consumer goods, retail sales, there is still some pent-up demand there that still needs to be fulfilled. In terms of Korea, we expect growth is moderated. They've had their correction so they had their election in March with the election of President Yoon. But what we can say is that when we look at previous rate hike cycles in the United States, what we do see is that in countries ex-China or Greater China, there is a larger impact of capital outflows leaving Southeast Asia when interest rates rise in the United States. So we have a tactically reduced position in Korea. It was around 20%. We're down to about 12 to 13%. And it's still around mainly chips. In India, we have about a 1% position in India. It's made up of 3 companies, so we're starting to see some value. It's still very expensive as a market as a whole, but we're uncovering some pretty good gems because we have a dedicated resource looking at Indian companies now. So we hold 3 companies. One's in the IT consulting space. We've hold another company that's in it's effectively a conglomerate that we think that the Indian government has a plan to increase spending in the infrastructure space, and they specialize in public-private partnerships. So we think there's some good value there to be had. And the third one is that we hold a bank which is riding on the back of the banking restructures finished, as well as the growth in private wealth, which is a theme in our portfolio for quite a while now, which we think is a secular one longer term. If we then look outside of every other country that I've talked about, our effective exposures are in Singapore and Indonesia. So in Singapore, we've decided to be a bit defensive. We're holding, so we hold about 4 or 5% in Singapore. Half of that is in REITs, purely as a defensive play, picking up the rent, as well as a few food agriculture companies, because we think the food inflation thesis is going to play out quite well. But again, that's still quite defensive. And in Indonesia, we bought a couple of financials because the valuations have come off, again, because of capital flight. But if we look at a lot of the ASEAN nations, outside of the more sophisticated ones like Singapore, what we do see is that Indonesia provides better stability at a government level. And so valuations plus stability of their financial system and government gives us confidence that it's a pretty defensive play for us in Indonesia. The 2 themes I want to quickly go through today, the first one is high performance computing. So this is going back to that whole theory that, you know, are chips and the demand for chips falling off? We simply don't think is the case. More than half the world's global demand for high performance computing. So this is all to do with 5G and in the future 6G, because China is currently developing 6G technology. All that to create the AI, so artificial intelligence, the focus on driverless cars, all that requires high performance computing. So we don't think that this is slowing down, and the projections from most global research houses is that, you know, even for next year in 2023, we're looking at 64% of the growth of the HPC market is going to be in Asia. Furthermore to that, we are expecting that there is going to be a huge growth once 3nm nodes come out. So for those of you that understand the whole semiconductor space, and I think there is more and more that is getting a bit more understanding, which is great, is that the smaller the node, the more power efficient your chips are, the more powerful they become, and the more chips you can, or the more nodes you can cram into a chip. So You may have seen Apple's come out with an M2 processor now, which is the next generation. It's still actually using the same node size from 2020 for the M1 chips. And that's because there's been a lag in the development of 3 nanometer nodes. But what you can see here is that the demand into 2023 and then 2024 is most of it's going to be from Apple, which is that sort of yellow line from there. And so TSMC, even though it's had a shocker in terms of share price recently, it had a great Q2 in terms of earnings, and we think that reflects, our continued holding in the company longer term as a secular trend. So this is the share price of TSMC. They hold more than 50% share of the global outsourcing market, so OEM production. And what you can see is their price has sort of fallen from 650 down to about $420, $430 till early July. But we think we think it's obviously creates very, very good value for us to continue holding the company. Then let's get back to the company that has the most controversy, which is Alibaba Group. Most people know what Alibaba do. They control more than half the world's outsourcing and B2B linkages in terms of outsourcing. Then they run a whole range of e-commerce platforms ranging from really cheap goods at Taobao. Then you've got AliExpress and Alibaba, which is sort of more regular goods like Amazon. Then you've got Tmall, which is the sale of their high-end clothing, your Nike stuff, your Unilever, Apple, things like that. And they also have Alipay, which is the digital payment system. This has been a recent play for us. We now hold around 5% in the China fund, not the Asia fund, to be very clear. In the China fund, we've made a 5% tactical allocation to Alibaba. The rationale for that is because we think that Alibaba is still a very highly challenged company, but we think the valuation is simply too cheap. So this is going back to our relative value stance as a manager. And when you're looking at Alibaba trading at 15 times 2023 PEs with a 6.2% earnings growth, we think that is actually still very, very attractive at this level. So late 2020, we used to value Alibaba anywhere between 25 and 38 times. So if it got to 38 times, we'd sell, 25 times we'd buy. Post the issues with Ant Financial and the anti-monopoly crackdown, that has changed dramatically for us, and our valuation band is now 15 to 25 times. So now at 15 times, we just thought it's just too cheap to miss out on a revaluation of the share price when the market reflects that. Because remember, right now, what we've seen, even with the negative performance in the first half of this year in Asian markets, it's been more about capital outflow than actually anyone getting concerned, because the capital outflow is driven by US rate rises. So hence, anyone that's sort of seeing the opportunity now, it is not around fundamentals, because especially the Chinese equity market has been priced so deep into the red in terms of the negativity. That is very different to Australia or the United States or even Europe at this current point in time. So in terms of our strategy, being relative value, we decided to exit Alibaba sort of in October, November of 2020, after they failed to list Ant Financial. We knew then that there was going to be an attack on Alibaba's business model, which I've talked about at previous webinars, and we've just been waiting patiently to get to a point where we felt comfortable in starting to reallocate back into them as a tactical play based on valuation basis. The other last thing I want to talk about is wealth management. The wealth management market is we're talking about a huge upside. Now, everyone talks about the Australian pension market and how big of a market that is, and we're talking about it's about 125, 130% of GDP as a percentage of GDP is the size of our superannuation system, whereas in China it's 2.2%. Okay, and China's had this transition of 3 pillars of the pension system. And over the course of those 3 pillars, what we see is that they've launched number 1, number 2, in which the most of number 1 and number 2 is around government workers rather than private enterprise, and more around urban rather than rural. And this 3rd pillar is going to basically underpin the growth of the Chinese pension system over the next basically 30 to 50 years. We believe that's a huge secular growth rate. what that also does, for those of you that understand the structure of the Chinese share market, is that if you have growth in the pension system, the money is also going to be more sticky, and you see less volatility, and it's going to be less subject to capital flight. And so at 2.2% of GDP, there is a huge runway of growth to go. Then you've also got total pension assets. Sorry, I forgot to change the title here. This is actually the national savings rate. And the national savings rate in China is 44%. Australia doesn't even rank here, but the average of the OECD members is about 22%. So there is a huge play at the moment in terms of where private wealth is being held in China, which is pretty much being held in property. And because of the, I guess, the restructure of the property sector, there is a huge growth and secular growth opportunity in wealth management and wealth management platforms. So where we're playing in that space is a company called East Money. Think of East Money as a combination of one of our retail platforms in Australia, like a Macquarie Wrap plus a CommSec put together. And what you can see here is that the gray line represents their revenues. The market share as a percentage of stock turnover in China. So they have basically gone from about under 2% in 2017 to now about 4% of the market share of stock turnover in China. And their net profit continues to increase. It's a very profitable company, but no one's heard of it outside of China. So we're basically gone here is that we've been in and out of this company, and you may have seen in the top 10 holdings over the last 12 months. Again, it's based on the valuation, right? Our portfolio is high turnover. All our investors understand that. That's completely fine because of the quick movement in share prices in the Asian equity markets that we participate in. So this is a structural story. We most likely will talk a lot about more of this later in the year because there's a lot more information coming about the third pillar, but we believe it's a strong underpinning of the Chinese equity markets longer term, and on a valuation basis is very, very attractive. So our three main buckets at the moment. So our technology names haven't changed too much compared to a couple of months ago. In terms of the domestic consumption, we've added China Construction Bank to the portfolio. We think all big four banks in China are doing reasonably well. Valuations are all quite similar. We pick CCB because their private banking function, as well as their management, we believe is higher quality than the other three, and East Money. And then also value with conviction on the right-hand side, we've got China Mobile, CNOC, and China Resources. China Resources Land is a property developer. Yes, that sounds very scary to everyone, but they're a state-owned enterprise, which makes it very attractive to us because it fits with what we call the ultimate survivors in terms of where the property development market will land when all this finally washes out. But be well aware that as we see developers default on their debt and looking at collapse because they can't fund cash flow, this will take years to play out overall, but you just start seeing headlines, whether it be Evergrande or Shimao, which are the two sort of headline names, and we didn't hold any exposure in either of those companies, either on an equity or on a fixed income, their corporate bonds either, as we said right here. So we've avoided Alibaba, as I said before, but we recently rebuilt a position purely based on the valuation set. In terms of the pre-major fund, obviously we continue to kick strong long-term goals. Yes, this year has been challenging, no doubt, but we're not, obviously we've always focused on the long term. Corrections happen, peak to trough at the moment, our correction's about 23% net. And so what we're, as I said, a lot of that in the first half of this year has been driven by capital outflow due to the fact that that there's been capital flight. So even in saying that, our long-term track record since 2009, we've outperformed the incumbent, which is Platinum Asia, most years than none, and we also had a higher fee base. So in Asia, if you're active, yes, you may have a higher turnover, but your performance speaks volumes. And we've been here before in 2015 to 16, where we had the very severe correction in the Chinese equity markets, peak to trough. Market dropped 27%, took 14 months to recover. We're sort of similar level now. And so what I urge people to think about is the long-term opportunity set. And we are playing a more defensive play card at the moment. And our long-term Sharpe ratios and information ratios against our peers still remain very, very strong outside of the information, outside of the 1 year mark, which obviously I would say that our attribution or our detractors have been mainly coming from the consumer stocks that we've held. And if we think about, okay, do we have any regrets, or is there anything we could have worked on or we could have changed earlier in the cycle, is that we could have reduced our holdings in consumer stocks earlier to cater or factor in the fact that with COVID lockdowns in China, that there'd be a reduction in consumption. Okay, because retail sales right now, to be very frank, is not all that strong. But we think that the market's now priced that in, and hence we don't regret holding them at the current valuation level. So with the Prime Asia Fund, as you can see here, this is our geographical split. We are effectively holding more of a Greater China portfolio. So you can see here that Hong Kong, Taiwan, H shares, A shares, red chips are all China. So our largest weighting is still South Korea, if you're talking about ex-Greater China at 12%, which is already underweight compared to 12, 18 months ago, we had about 20%, so tactically underweight. And then you sum that with Singapore, Indonesia, and India, you basically, you are getting less than a quarter of the portfolio is in Asia. And that's reflective of uncertainty. Post-COVID reopenings, we think China will fare better than Southeast Asia, and the capital flight has also led us to think that the financial systems are a little bit more fragile as well. And you can see there on our sector exposures, we've started to increase our holdings in real estate. To be fair, though, that's 6% of real estate. Half of that is Singaporean REITs, as I mentioned before, but we've also, as I said, tapped into the banks and insurance companies now, given that we believe the market's bottomed out. And that is purely reflective, even as a value manager, that we are holding zero cash in the portfolio, literally zero cash at the end of June. So that reflects how strongly we think the conviction levels we have in the current market. In terms of the PE, we're bang on 10 for the Prime Asia Fund, with the price to book of 1.4, dividend yield of 3.8. Now, what can we garner from this? Effectively, what we're saying is that the dividend yield of our funds have never been high. For those of you that have invested with us for a very long time, even those all the way back to 2005. And what you can see here is that you've never seen the P's this low. We're paying a pretty defensive bat. And the dividend yield is really, really high because we are playing in the space now where we're running those low duration stocks and low duration portfolio, which have really strong underpinning of cash flow, whether that be from REITs or semiconductor companies or banking stocks, right? So you can see that reflected in the portfolio here. As I said before, you look at where we've made our most money in the last 12 months ending June on an attribution basis. We made it in, the oil price, which is CNOC, some of the industrial companies. So China Resources Land, as I said, that's the SOE property developer. We're buying them at 3 times PE. We're going to make good money longer, medium term. China Mobile, industrial companies, as I said, a lot of those traditional industrial companies we haven't held since 2009. But because the valuations are so cheap, we think that they're well defensively placed. Cash flows are really strong. Upside potential is also really, really strong. And all, the detractors in the portfolio is really around consumer demand and semiconductors, which you've seen mainly around that being TSMC. In terms of the China fund, again, we've outperformed our benchmark since inception, and we're now in our 17th year. So we're very, very proud of our track record. Yes, it's always been a volatile ride, but no one's investing in China assuming that it's not. In terms of the sector exposure, because obviously this is all Greater China, what you see is that I guess that the key difference is that we're holding a little bit more in real estate because we're bottom feeding. In terms of relative value, but again, most of it is reasonably similar to the Asia fund, and also we're holding effectively zero cash. We're also holding a little bit more energy in this portfolio because there is a number of supply chain points of solar, because China is the largest producer of solar, for those who don't know, and so there are different input companies that go into that supply chain cycle for solar energy that we really like. And so while we're not buying the solar energy companies, we're buying the people that produce fiberglass and things like that that go into solar panels, where we think that's the better bang for buck, because we're not relying on the value of solar energy on a kilowatt basis to make money, because we think that that's still a little bit too risky from our perspective. And the portfolio here is a little bit lower. The portfolio PE compared to the Asia fund is 9.6 times, but the dividend yield is similar at about 3.8%. And as you can see here, that the portfolio, we don't have as high of a concentration at the top end anymore. 2 years ago, we had stocks at 10% weight, which is our maximum, but we've basically reduced that. And you can see that in the China fund, our third highest weighting is now that 5% in Alibaba as a short-term tactical play. One of the questions that have just come through asking about, what long-term earnings growth rate do you expect from Alibaba, given the 6% doesn't justify the current PE? We think the earnings growth rate isn't going to jump very high from here. The fact of the matter is more that we are purely playing this as a tactical play. As I mentioned, we don't have a huge positive vibe from the future of Alibaba at this point. The historical numbers are great, but going forward, we think they're still going to have a lot of headwinds. So again, that is I would say it is a short to medium tactical play. And as you can see here, not too dissimilar to the Asia fund, our key detractors have been around that same consumer space, whether it be, China Tourism Corp or Antisports, which is your Nike and Adidas of China, and same contributors being the oil play, property developers, and also wealth management. So this is Bank of China, Hong Kong. Here are our contact details for each of us. So myself, I look after Victoria, Tasmania, and South Australia. Derek, my other colleague, looks after all the other states in Australia. And for those of our friends, I see a number of you today across the ditch in New Zealand. You've got Clayton's contact details there as well. So with that, I don't see any other questions coming up on the screen. Thank you very much for your attendance. Thank you very much for your ongoing support and patience, especially in the most challenging times at the moment. But rest assured, we are still, sticking to our knitting. We are trying to find value stocks. We're trying to make tactical plays. And given the global environment, because we expect increasing interest rates and volatility in the market, we are running a more lower duration portfolio for the benefit of your investors. So with that, I'm going to close off the webinar now. Tomorrow, 12 p.m., we'll be running our fixed income update. And in the meantime, if you have any other questions, please reach out to us. Thank you very much.